exercise 6.3 in your text, this is labeled problem 3. In Connect, talks about absorption costing and variable costing. And let's go through and make sure we know what we're talking about before we go any further. This company makes heavy-duty street signs, street lighting. They use variable costing for internal management purposes, which is very common. And they use absorption costing for external reports, for shareholders, yeah, creditors, yeah, and the government because it's the law. The company's provided us the following data. And you see that in year 1, they had 200 units. They ended with 170, so that means that year the inventory went up $30, or yeah, 30 units. The next year they started with 170, they ended with 180, so their ending inventory went up. And in year 3, they started with the 180, and they ended with 220. And I just want to make sure that you see that those are those numbers, okay? Additionally, they tell us that the fixed manufacturing overhead per unit was $560 for all 3 years. That means that those years where they inventory went up, they stored some of those costs until they sold it, and in years when that inventory went down, they sold some costs from a prior year. That's the whole thing with absorption costing. So let's get started. It's not as tough as it looks, and the instructions are pretty archaic. Or archaic? No, they're just badly written. They want us to calculate each year's costing and net operating income and present it in the form of a reconciliation report. That means table. Then they say, assume in year 4 that the company's variable costing net income was $984,000 and its absorption cost income was $1,012,400. Did inventories increase or decrease? How much manufacturing overhead was deferred or released? Right now that sounds like an impossible question. When we get to it, you'll see it really isn't so tough. Okay, so let's start filling in this table. Well, we know that the fixed manufacturing overhead in each unit is $560 because they told us that. So I'm going to write that down so I don't forget it. So each unit, whether sold or stored, has $560 worth of fixed manufacturing overhead. Now, the beginning inventories are 200, 170, and 180. The ending inventories are 170, 180, and 220. The change in the inventory in year 1, our inventory went down 30 units, and each of those 30 units had $560 of fixed manufacturing overhead from another period. This year 2, our inventory went up by 10, and each of those 10 units had $560 of overhead from the period that they were saving. and went up by 40, and again each of those had $560 of saved overhead. Okay, so let's just go through and take a look at the fixed manufacturing overhead in the ending inventories. And all we need to do is we need to take the ending inventory 170, and we're going to multiply it by 560. Can you see that? Just barely. You'll have to take my word for it. We're going to take the 170, multiply by 560, and we get 95,200. So there's 95,200 of fixed manufacturing overhead in that 170. Now we'll multiply 180 times 560, come up with 100,800, and again that says that for each of those 180 units there's $560 of fixed manufacturing overhead allocated to that unit. And we'll do the same thing, 220 times 560, 123,200. Now they're going to ask us how much was the fixed manufacturing overhead in the beginning inventory. So now we're going to take the beginning inventory and multiply that by 560. So the beginning inventory for year one was 200 times 560. That's 112,000. And we already have these numbers. The beginning inventory for year two is this. We have 170 units at 560 each. And for year three, we have this, which is the beginning inventory from last year, or the ending inventory from last year is the beginning inventory from this year. This is the difference between absorption and variable costing. That line right there is the difference, because that's fixed manufacturing overhead in inventory. That's fixed overhead that we have calculated and put in inventory. Okay? And that's why we have to fuss with this, because the overhead is in inventory. And the reason that we care about this is while we put the inventory or the overhead in inventory, we really paid for it last year. So that's the big debate. Okay, now, did the inventory go up or go down? If the inventory went down like it did in year one, we released 30 units worth of 560 from inventory. The beginning inventory, 200 units, each one had 560 from a prior period. This year, our ending inventory was 170. It was 30 less, which means that those 30 we used up inventory from prior years, so we have to account for that. So 30 times 560, 16,800. So that's 16,800 from a prior year that we applied to this year. The next 2 years, our inventory went up, So 10 times 560 is 5,600. That means we stored $5,600 worth of this year's overhead in inventory that will be recognized in a later year. And in year 3, the same is 40 times 560, and that's 22,400. Okay, so variable costing net income. How do we come up with that? All we have to do is either go through, look at the variable cost per unit, but instead of that, it's actually easier. They gave us the variable costing net income. I was going to show you how to compute it, and this is easier. They gave us the number. Write it down. So the variable costing net operating income for year 1, 1,080,400. Year 2 is 1,032,400. Year 3, 996,400. That's the variable costing net income. They told us that. They also tell us that that's what we use for making management decisions. That's what we use to report to our stockholders. That's what we use when we talk about our production in the boardroom. It's not what we use for reporting for tax purposes, because we're not allowed to. So what we need to do is either add or subtract the fixed manufacturing overhead. So here we released 16,800. Our inventory went down, so this is from a different period. So we have to subtract that from our variable costing operating income. This we deferred to a prior period, so we add that because we're going to recognize that expense at some later date. And the same with this, we'll add that because we're going to recognize that at a later date. We'll do that addition, and we come up with 1,063,600, 1,038, and 1,018,800. And the whole difference, the whole key to all of this nonsense is the fact that we are adding or subtracting that, because that's overhead from a prior period that we're either using up, releasing into the stream, or saving, deferring, putting aside. Okay, the next part it wants us to know, wants us to figure out, excuse me while I get my notes. What's going on here? Well, the absorption costing, our inventories went up or down. Now it tells us in year 4 that net operating income was greater than variable costing. So let's go back to our chart and see what scenario would do that. When our operating income is less under absorption than variable, that means our inventories went down. If our operating income under absorption is more, it means our inventory went up. So that's our clue. That's the clue we need. Notice that here, inventory went down, operating income went down under absorption costing. Here, inventory went up, operating income under absorption costing went up. Okay, so we know that the operating income, that the inventories must have increased. Had to. That's the only way that you end up with that scenario where the absorption income is greater than the variable. And the fixed manufacturing overhead was deferred in inventories. Well, that's the definition. That's what happens. And the difference between the two, and they tell us in the problem, that the variable costing was $984, the absorption costing was $112. The difference between those two was the amount of overhead deferred, or $28,000. That's the $1,012,400. They gave us that number, minus $984,400. That difference is $28,000, and that's overhead from a prior period saved in inventory to be released into a future sales stream.